I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE, symbol CRL, and the Pink, symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim. Here we are.
The market's 3 days down, 1 day up. Is this a pattern you've seen before?
Yeah, actually, it is, because the market has suffered a mighty whack. And it was also a seasonal one. We had, of course, been advising people to build liquidity during the rallies through the summer. But what you have had is a huge financial bubble. And essentially, if you use the New York Stock Exchange Composite Index, and then there's a World Stock Index without the U.S. in it, and they set their highs in January it was the month after the Bitcoin bubble blew out, and we took that Bitcoin bubble to be the really historically a great item, and that it probably was, when it failed, it might be associated with other parts of the stock market failing as well. Now, this was, of course, in doubt until through to September. You can also have a nice seasonal high in the New York market in September. And then it rolled over, and then people discovered that owning exceptionally high-valued stocks that had set, great momentum figures was a very risky business, and it's difficult out there because people are, and to say investors may be holding investment grade stocks. So you think a good company, I'm all right. But the problem is it's speculators who push the prices up to measurably speculative levels. Okay, so then that gets the vulnerability into it. And what we were watching for during the latter part of the summer would be the yield curve reversing from its long trend of flattening, which it did do. And the other part would be credit spreads, which had been on a long trend to narrowing, reversing to widening. And those came in and sort of helped make the decision that the market would come under some selling pressures into the fall, which we've had. So then, once it cracked, then we brought out our old historical fall pressures history. And on that one, you can have really heavy liquidation down to, say, late October, which we got, then some relief. And then in November, all of that selling pressure would be tested. It need not make new lows, but just everything sort of gets tested. And we're looking at the technicals on this stuff, and things are really quite oversold and beat up. So you can have some work in here churning around, and probably some recovery into the new year. But in my mind, Jim, the greatest financial bubble in history has been severely damaged, and in which case what we want to do is go back in history to determine what happens in a post-bubble world, and it's very methodical. As a matter of fact, the great bubbles and their concluding moves are very similar, whether you're looking at it recently or in 1929, or the previous bubble was 1873. Going into the climax is similar, and coming out is similar, and we can review that.
Well, of course, for the last 9-10 years, the feeling has been everything's going to just keep going up. But of course, this time isn't any different than the last time, is it?
Yes, that's one of the most dangerous saying in financial market history is, but yes, it's expensive, but this time it's different. And you can say that, they say that every time. So, the point being is that the market, a bubble is such a fantastic thing, and all of the positive vibes, and of course, it's been a long bull market. If you go back to 1982, and you had nasty bits in between, like crash to 2001 and then 2008. But essentially, the era of financial asset inflation started in 1982. So you can't correct these unbelievable excesses in a short time. Even we're just looking at market sentiment, which got extremely high. It got way higher than in 2007, and of course, that market sentiment has come down, but it's not anywhere near what you would see. Even on the stock market hit in 2015 down to early 2016 when crude oil got trashed down to $26. The market sentiment came down on that one, and we could call that a correction. But at the moment, the market sentiment is nowhere near that, and of course, nowhere near what it was in 2009 at the bottom of that bear market. So there's a number of measures, Jim, where we can say this, although it's been a hard hit, it is not yet ending action on the downside. So we're just watching for trades in here. The whole market has shifted. In a long bull market, of course, the successful ploy is to buy the dips. And that's where our technical research is good, because we had the springboard buy model, which buys the dips. And then now we're in a different world, probably a long declining model. We've done a little alteration to that model, and it's now a bearish springboard where it'll help a person sell the rallies. So not everybody's a trader, but there's still times when people have to execute and change portfolios. So we've got the tools that called for this hit, and we've got the history that suggests that we're in for a fairly long contraction, a credit contraction, because this is all what the party is about. You have soaring asset prices, and whether it's in commodities or real estate or stocks, or even on the fixed income side, the credit markets, everybody gets leveraged, and it does take a long time to unwind all of that stuff. So it's going to be fascinating.
We'll have more with Bob Hoye right after this.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the pink CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Bob Hoye. Bob, the chair of the U.S. Fed, says one or two more interest rate hikes and he's probably done. Does the Fed set the trend, or do they react, or are they that important?
Jim, your term reaction is key. Again, we've done the history, and on these major moves in interest rates with a boom, and it's very simple. Throughout business history, interest rates go up with a boom and they go down in the bust. So this is where it was certainly on the 2000 bubble, and it was there on the 2007 bubble, that as it became nervous in 2007, the Wall Street came out with lots of comfort stuff about, but the Fed will cut rates. And what we for decades have been saying, in a boom, interest rates go up, and in a bust, they go down. So then the other part is the role of the central bank in the game, and you have two kinds of interest rates. You have what they call the administered rate, which in the case is the Fed funds rate, and that is the one that's set by policy. Then you have your day-to-day, hour-to-hour interest rates, like, for example, the interest rate for treasury bills. So the record shows that the senior central bank, on the end of a bubble turning into a contraction, is behind the market. Now, we've had a sharp rise in 3-month T-bill rates. Got up to high momentum on I'm looking at it on the monthly RSI, got to higher than in 2007. And so we've been watching for the reversal in the treasury bill rates, and it's begun to decline this week. But as you said, the Fed is still talking about possibly further hikes. So it's going to be the case, as with any contraction, the T-bill rate falls, and then the central bank gets in line with markets and drops its administered rate. And yet you got so many thousands of pundits out there all thinking the other way around, that, what is the Fed going to do, when all it does is follow the market? So I think I've been watching for senior spokesman to say that, the Fed will cut rates and everything will be well. But I haven't seen one. There may be out there, but, I haven't noticed one. So maybe this type of market commentators are getting a little wiser than they were in 2007. So, but it remains to be seen. The other thing they've got is that the slush fund, where they can plunge protection team, where they can buy on a hard sell-off and kind of help a bit that way. But when you're into this kind of a market, there's no way that could be used to drive prices to new highs. The market has been seriously damaged, and you've got now the credit markets have turned to adversity, and you've had weakening industrial commodity prices. That's a negative. Also in that one with crude oil, our comment in August was that no matter what it did through September, that we were looking for then a seasonal low in December, January, and that it could be a dismal low for crude. And its high, October 3rd, was 77, and it's been down to $50. Now that's pretty dismal, but it doesn't quite fit yet with a probable low likely in January. So crude, very oversold. It could rally for a bit, but you have to wait for that seasonal weakness period to clear before you could look for a rally on that. Also, the other one we had, base metals down to maybe a seasonal low in November, and that one worked out. So all of this will, whether you're looking at credit markets or industrial commodities or the stock market itself, this has to kind of settle down before you can get a worthwhile rally out of it. And the likelihood is that would be a rally within a bear market anyways.
We'll have more with Bob Hoye right after this.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, if the Fed stops hiking interest rates, does that mean the U.S. dollar will fall?
Oh, good question. No. This business about currency strengthening because it's got higher interest rates, that's sort of a legend. In the post-bubble contractions in the past, the senior currency has become chronically strong against most other currencies and most commodities for most of the time. That's it. You get into deflationary conditions, and one way I've defined it is that in the 1970s, there was inflation in tangible assets, commodities, wages, everything like that was the big deal, and the CPI inflation got up to 15%. And then that burns out, and then you shift over to inflation in financial assets, which game has been on for a long time with some huge swings. But Jim, it's the public that chooses. The public chooses to speculate in commodities, and then it chooses to speculate in financial assets. And then when that one's over, it chooses to hold cash. And it's called hoarding, and it drove the economists and policymakers crazy in the early 1930s, where people just held on to their cash, and this has been the consequence of every great financial bubble since the first one in 1720. Once it's over, you go into kind of a watch out, careful mood, hoard your cash, trim your expenditures, and I think we're heading that way. The other thing is, typically in a post-bubble contraction, unemployment goes up. There's hardships with layoffs and stuff like that. And there are headlines this week about General Motors laying off people in Canada and the United States because people are not buying cars anymore. They're buying SUVs, and they're built somewhere else. So those plants are become not needed. So then each country's politicians are looking at unemployment numbers, and they are compelled to do something about it, and typically what they do is they bring in protectionist measures. And that is not good, but it's the way financial history works. They had the great bubble of 1825, and then the crash on that one and the contraction, and the United States came up with a terrible set of tariffs. It was so bad at the time that they called it the Tariff of abominations. So, hate to be gloomy, Jim, but we're heading probably in that direction. So, and this then would offset, well, it's just the way the financial history has worked. So we can't build a case for a long-term bull market. You can build a case for that we're probably early stages in a bear market. But there are opportunities, eventually, within a contraction. You've had a very good gold market for the real price of gold going up and gold stocks performing well, but we're not there yet. We'll use our technical research to get us positioned in there, in the gold. So, very interesting times.
Bob, thank you so much.
There we are, Jim, and we look forward to talking to you next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. You're listening to HoweStreet.com radio. Find us on Twitter at HoweStreet. Our YouTube channel is Talk Digital Network. If you have any questions for Bob or any of our other guests, you can send them to info@HoweStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of Howe Street Media Incorporated.